The break of structure plays a crucial role in trading as it serves as an indicator of potential price movements. By recognizing when a swing high or low is breached, traders are empowered to make informed decisions regarding their positions. Incorporating a single time frame into trading strategies simplifies the process and enables traders to concentrate on key price levels. This streamlined approach can yield consistent daily trading opportunities while avoiding unnecessary complexity that might obscure important signals. Furthermore, it is essential to identify the prevailing market structure, be it trending or ranging, for executing successful trades. By pinpointing support and resistance levels, traders can better anticipate future price movements, enhancing their decision-making capabilities. In addition to recognizing market structure, identifying opposing candlestick colors is vital when determining potential buy zones, as these colors reflect shifts in market sentiment. Employing this technique can significantly improve trading effectiveness and yield better outcomes. Moreover, achieving a favorable risk-reward ratio, such as 1:4, can facilitate rapid profits in trading. This strategy proves particularly effective in shorter time frames, including the 3-minute chart, where swift movements occur. Proper stop-loss placement, coupled with a clear understanding of price rejection signs, is crucial for enhancing trading outcomes. By carefully monitoring these factors, traders can make timely decisions and effectively manage risks throughout their trading activities. In addition to risk management, identifying market structures and zones remains essential for accurately predicting price movements. Traders are encouraged to focus on present data, avoiding the temptation to shift to longer time frames that may dilute their analysis. Recognizing price patterns such as double tops or bottoms can serve as indicators of potential market reversals. This knowledge equips traders with the ability to make informed decisions regarding their entry and exit points. Setting appropriate stop-loss levels is vital to avoid premature exits from trades. Employing a tight stop-loss can inadvertently increase the likelihood of losses, underscoring the critical importance of effective risk management strategies. Understanding market inefficiencies can assist traders in identifying potentially profitable opportunities. It is imperative to consider broker fees, such as commissions and spreads, when conducting trade analyses, as these factors can significantly impact profitability. Utilizing proper risk-to-reward ratios is fundamental for the formulation and execution of successful trading strategies. Aiming for at least a 1-to-2 ratio can contribute to enhanced profitability over time, ensuring a balanced approach to trading. Finally, recognizing breakouts and structural changes in the market aids traders in making informed trading decisions. Waiting for confirmation before entering trades minimizes risks, allowing for more strategic positioning in a fluctuating market environment.